Hello guys, in this video I will show you 5 ways to identify the dominant trend on a trading instrument, whether it's a stock, a currency pair or a CFD, so you can stay on the right side of the market when you are day trading. The first technique takes into account the 200 EMA and the 600 EMA on a 5 minutes chart. We'll use the 200 period exponential moving average as an indicator to determine the short-term trend and the 600 period exponential moving average to establish the medium-term trend. The 600 EMA on a 5 minute chart is the same with the 200 EMA on a 15 minutes chart. So basically we are following the 200 EMA on 2 charts. That's a little trick to follow one of the most efficient moving average on 2 time frames without having to change charts. So in order to identify the trend, the 2 exponential moving averages must not cross during the previous day or days, because as day traders, our aim should be to trade only the strongest trends. If the EMAs will cross, then we will most likely enter a trading range. Let's take a look at this Visa 5 minutes chart. If we want to identify the trend, we just have to look back in the previous 1 or 2 days. If the moving averages do not cross, we have a valid trend and we could start searching for long entries. Here's a downtrend on a Verizon communication stock. Take into account that the moving average is a lagging indicator and the 2 EMAs don't predict new trends, just confirm the market trends once they have been developed. In this chart, we see no crossover between them and we can safely assume that we are in a downtrend. When you see a crossover or multiple crossovers between the EMAs in the previous day, like in this Netflix chart, abandon the setup because you will most likely enter the market when it's in a range and go search for other day trading opportunities. The second technique takes into account the main central pivot point of the day. Pivot points represent levels that are used by floor traders to determine directional movement and potential support and resistance levels. They became popular once traders on the floor exchanges began to use them. In order to identify the trend, I just focus on the central pivot point. The central pivot point represents the intraday point of balance between buyers and sellers and is usually where the largest amount of trading volume takes place. Here's how I determine the main trend. I prefer to compare the value of the main pivot point with the value of the previous day. If the current pivot point is higher than the previous day, I consider this a good indication of an upward trend and look only for long positions. If the current pivot point is lower than the previous one, I consider taking only short entries because we are in a potential downtrend. I also take into account the distance between the main pivots, the range between them. Pivots drawn with a larger distance between them indicate a trending market. Pivots drawn at a short distance one from another indicate a possible range. I avoid trading on markets where the most recent pivots are close, as it will most likely stay flat and offer low probability entries like in this AT&T chart. The third technique involves the Kumo cloud of the Ichimoku indicator. The Kumo cloud offers a unique perspective of support and resistance, representing these levels based on price action. The longer the price stays below or above the Kumo cloud, the stronger the trend is. Also, when a cloud is wide, the expected support or resistance is strong, and when the cloud is thin, the expected support or resistance is weak. If I want to see if the markets are trending or not, I want the Kumo cloud to keep its color. So I want to see green in the last 1 or 2 days without any red, like in this ExxonMobil chart. And here's a great downtrend. Observe the Kumo cloud keeping its red color, the price staying below the cloud, and the cloud is pretty wide. meaning that the trend is a strong one. When you see this on your charts, that's a pretty strong indication that the market is in a range. So when a price breaks below and above the cloud, and the cloud changes its color often, search for better opportunities on other instruments. The fourth technique takes into account the ADX line on the 30-minute chart. ADX is one of the most reliable indicators to anticipate the beginning of new trends or a continuation of the current ones. What I like about the average directional movement indicator is the fact that it measures the trend's trend and shows trend direction at the same time. When the ADX stays above the 25 level for several days, trend's trend is strong enough for strategies involving trend following. I checked the ADX line in the previous 1 or 2 days, and if I see that it clearly stays above the 25 level, we might have a good trend to ride. Remember that ADX is non-directional, does not distinguish between uptrends or downtrends, so look for higher highs and lower lows and ADX above 25 level for uptrends, like in this example, and lower lows and lower highs and ADX above 25 level for downtrends, as you can see on this chart. The fifth technique takes into account the slope of the Keltner channel. The Keltner channel is a combination of an exponential moving average and the average true range indicator. The Keltner channel uses the average true range to determine the channel distance. This indicator doesn't predict new trends, just confirm the market trends once they have been developed, like in the case of an exponential moving average. An easy way to establish the main trend is to analyze the slope of the Keltner channel. The Keltner channel slope is simply the direction of the channel plotted on the chart. An instrument is considered to be in an uptrend when the channel's slope is upward, and is considered to be in a downtrend when the Keltner channel slope is downward, like in this chart. It is also better for the price to stay above or below the channel without touching it. When the Keltner channel slope is flat, this is a signal that the market is in a range. In other words, no main trend is identified on the market. You should avoid taking positions when this market condition is met. Keep in mind that trend analysis is only one part of the overall trading strategy you should employ to enter and exit trades. It is never a good idea to enter a trade based on one factor alone, which is why you must look for as much evidence as possible to confirm a trade. If you got any value from this, please consider subscribing to our channel, share and like this video, as it will help us a lot in the future. Until next time.